Market strategists seem to be split on whether global benchmark indices are continuing to climb or are setting themselves up for a further fall, bringing in new lower lows for the year, possibly. In our weekly IG Trading the Markets podcast, we thought it was time to bring in expert opinion to pick up on a question IG has recently been asked from a client. I have £100,000 I've received from the sale of a buy to let. What should I do with it to avoid seeing it eaten away by inflation? Inflation here in the UK, of course, at the moment is at 10.1%. Citigroup has suggested we could well see this rise to 18% sometime in the next year. Well, joining us is Chartered Financial Planner Megan Rimmer from Quilter Private Client Advisors and Investment Manager David Henry from Quilter Cheviot. Thank you so much indeed for joining us.
Hi, Jeremy. Thanks for having us.
Morning, Jeremy. Thank you.
Megan, to you first, if I can, with an overview of why invest? What are the benefits of market exposure?
Yeah, absolutely. It's a very common question. Well, the reason typically why you would look to invest is to try and achieve some growth over the longer term in and above inflation, very similarly to what your client is asking about, which, as you quite rightly pointed out, is particularly prevalent at the moment with inflation at its current rate of 10.1%. With regards to your client and the question that they're asking, I always think the starting point is not necessarily what the underlying investments should be. It's actually what's the money for? What's the objective for this money? And where should they hold these underlying investments? So the actual structure of where you hold your investments is just as important as the underlying investments themselves. For example, do you look to put some money into a stocks and shares ISA? Do you look to utilize your capital gains tax allowance every year by having a general investment account? Or actually, dependent on the client's income and their age, is there scope for them to make a large pension contribution and receive some tax relief? So just as important as it is to invest, it's equally as important to think about where you're going to hold those investments, which would be my main thing to your client.
Yeah, it's interesting, isn't it? This thing about age, and of course, risk appetite as well, as to how risky we are in terms of our appetite. Some people, obviously, at a younger age, are more willing to hold more risky investments
Yeah.
with a view to having them return at a greater rate over the longer term. What do you perceive as the risks at the moment on the markets?
I mean, crikey, there's always a risk with investing. That is the risk reward trade off. And I'll let David go into specific risks at the moment. But from my perspective, it's really important to not only make sure that you can tolerate a level of risk, but also to make sure that you have the capacity to take that risk. So, what do I mean by that? For example, if your client has decided that he was really comfortable taking a very adventurous level of risk, but actually said, I need that £100,000 in 6 months' time, then they don't really have the capacity to lose that money. And goes back to my point previously of saying, okay, what's the purpose of this investment? What's the objective? Because the time frame is really important. Like you said, someone that's younger, for example, with their pension, they're not going to retire for 40 years. They can afford to take a high level of risk because they've got the time to make back the losses. Whereas someone who is very close to retirement might not feel so much comfortable to do it as well. So really establishing the level of risk, but also what's the objective and can you afford to take that risk is really important.
I would absolutely echo what Megan's saying there. Your time horizon, the amount of time you have to invest and leave your investment alone is, I think, the number one determinant of how much risk in inverted commas that you can afford to
Mhm.
take. We are in the finance industry obsessed with talking about risk, not least because of the regulations that are put in place to protect clients and investors, which are very important. But risk doesn't just evaporate. It just takes different forms. So if you've got cash sat in the bank, the cost of doing nothing, as you say, Jeremy, over the last 12 months has been 10.1%. A 10.1% drawdown in the value of your cash in real terms, to me, sounds like quite a lot of risk. In order to hedge out that risk, you have to accept other types of risk, which is volatility in investing. So risk doesn't just go away. We just need to accept it in different forms. And a good advisor like Megan can help you as a client work out where you're taking risk and how to mitigate some of those risks so the risks are balanced across your finances. It doesn't go away, it just takes different forms. So, you can never hedge out risk entirely.
David, I want to stay with you actually, because the context Megan was talking about in terms of risk was also about the risks to the current market environment. As an investment specialist, how do you see the risk to where we are? We saw this big pullback in the markets back end of last year, tech stocks especially down. We saw the NASDAQ lose some 30 odd percent, well into bear market. We've then seen this rally, which we're now possibly describing as having seen a bear market rally. Where do you see the markets going? What do you see as the direction of travel?
Yeah, I mean, times like this are great for people like myself in this job or financial commentators because it gives you a lot to talk about. But in reality, if you've got an investment horizon that's long enough that Megan talks about, ultimately the day-to-day movements, what happens on 6 to 12 to 18 to 24 months doesn't actually matter. There are plenty of opinions out there about where the market is going in the short term. For what it's worth, the statistics would suggest that once you've had a 50% retracement off the bottom, so once you've made back 50% of your losses after going into a bear market, which we did a couple of weeks ago in the States, you don't make new lower lows. Historically, that's been the case since 1945. Similarly, we've just bumped off the 200-day moving average. We failed to break that in America. That is not typically good news. So that adds fuel to the argument that we are potentially going to see new lower lows and we're in a bit more of a downtrend. In the short term, it's impossible to know. I mean, I am a big believer at times like this and at times like we've seen over the last 6 months of leaning on history and leaning on statistics. Over a 12-month time period, you've got a 75% chance basically of a positive return from global stocks. So probability is on your side here historically, looking out 12 months, particularly considering the drawdown that we've seen, but nobody has got a crystal ball. The analogy I use with clients at the moment is the risks are known, a lot of them. The monster's out from underneath the bed. We know about inflation. We know about the war. We know that earnings are probably going to slow down if we go into a growth slowdown type environment. It's when the monsters are underneath the bed and you don't know about the risks that are coming down the road is probably the time to worry. But just reiterate what I said and in the answer to the previous question, risk never goes away. It's a fact of life, and we as investors just need to accept that as the price to earn returns which are over and above inflation.
Well, Megan, let's bring you back in on this and ask you the question, is there a good time to pull the trigger on a lump sum, bearing in mind what David's just said about the fact we can never really time the markets properly? What do you say about this idea about the fact that we've got this 100,000, it's losing, as David was saying, 10.1% over the last year,
Yeah.
possibly an 18% loss if you take Citigroup's look at inflation. That is a whacking great big knock to what is a respectable amount of money. And all of a sudden, we've got only 70 odd thousand left in terms of real value. What do we do about this timing and when to pull the trigger on a lump sum, pushing it into the market?
I think we can't time it. You can't time the markets. If we could, David and I would be sat on a beach somewhere, to be honest with you. It's about having the money in the market. As you said, inflation is so high. The only way that they're going to be able to try and get some growth to counteract that is by having the money invested in the markets. But this is why it's so important to think about what is the objective of that pot of money. Is it a 5-year investment, a 10-year investment? Actually, if we invested the whole 100,000, do they therefore have zero amount in cash? Because even though inflation's very high, you still need to have that emergency fund available. And what I would say is that it's really easy to get distracted by the noise of what's happening in the world. But ultimately, you've got to focus on you and what is your plan, what is your specific plan. And as I said, it all goes back to what I was saying originally, of actually establishing what's the objective of the investment and why are we actually doing this. So ultimately, there isn't the right time. It's the right time for them as a person. And what I would say is we've got clients at the moment who think it's a great time to buy because everything's cheaper. But it does come back to whether you have that length of time to take that risk.
Just to quickly ask, in the current environment over the last 5
Yeah.
or 6 months, has it ever occurred to you to recommend to clients to withdraw money?
No, not unless they need it. If they said, I really want to get my bathroom done, and this is really going to enhance my life, then no.
You weren't fazed by the war in Ukraine, with the potential of getting out of hand, and also this worry about rising interest rates. You don't see that as any reason to sell.
No, absolutely not. And David will touch on this more, but absolutely not ultimately. And don't worry, I get clients that call me, who are worried by the headlines. But ultimately, it's about coming back to what is the plan of this money. If this client, the purpose of this money is for 10 years, then the past 6 months is, over that 10 years is going to look really small in comparison.
Mm.
And, it's the psychology of this really comes into play, Jeremy, because like we were saying about cash, inflation's at 10.1%. People never see that risk. They don't feel it the same, because in their mind, all they see is the £100,000 in cash. You can't actually see the 10.1% coming off. Whereas with the markets, you've got that volatility, the figures constantly changing. And it's about sort of getting away from that psychology and identifying there is a risk to it. Like David said, there's always going to be a risk.
David, let's bring you in on this and talk a little bit more about this. What we don't know is the fact we don't know enough about the client, I guess, to make a proper decision. What would you need to know about a client to ensure that your advice is properly targeted?
Yeah, there's two strands to this, Jeremy. I think the first place to begin is, when do you need the money? Because as I said earlier, investment horizon, the length of time you can afford to invest for, is the key determinant of how much risk theoretically that you can take within the portfolio. I say theoretically because the other element in terms of risk profiling is human emotion. How comfortable are you going to be with short-term drops in the value of the portfolio? Not if they arrive, when they arrive, because they will. That second element, the human emotion side of things, is fuzzier and less clear, and an advisor, that is typically a long conversation with the customer that involves going through past drawdowns, modeling that based on the asset allocation that you're recommending for the client, and coming to an agreement as to whether they would have felt comfortable enough to remain invested during that period. You mentioned the risks that have materialized so far year to date. To me, again, it shows the importance of having an appropriate asset allocation at the outset. But because by the time these risks materialize, you don't buy insurance when your house is already on fire, do you? You've got to have that appropriate asset allocation at the outset, and got to be prepared for these events because they do come. So to answer your question, what would we need to know? Assuming the structuring's been done appropriately by someone like Megan, time horizon, I think, is the key one. And then you have a conversation about historical drawdowns and build an appropriate asset allocation from there.
What would you say about this idea about market timing?
So the question that you've sent across, Jeremy, is one that we get frequently. I say that people come into money two ways: gradually and suddenly. So lump sum investment tends to be suddenly, right? You sell an asset, you sell a business, you receive an inheritance. Crikey, you could even win the lottery. So for people in that situation, I think the timing of the initial investment is a bit more difficult, because people naturally want to do the right thing, in inverted commas. If it's potentially life-changing sum of money, then the weight of responsibility can weigh quite heavily. This is my advice, and this is my mental framework for clients who find themselves in this situation. And these three options, are very much in order of preference. So option number one, invest a lot immediately. So downside, it might fall in value immediately after you invest. It might even fall by a lot. But asset prices, historically, probabilistically, go up. If you picked any random calendar year going back to the beginning of 1971 to invest in global stocks, you would have ended the year with a positive return just under 3/4 of the time. And the probability of a positive outcome improves as your investment period get longer. So the odds are on your side when you choose to invest. If the worst does happen and the portfolio falls initially, I would ask, does this really matter? If you're making the decision to invest, you should be investing at least for a few years. So coming back to the question of when do you need the money, it won't be in those early stages. So that should help you ride out that initial short-term volatility. Getting the money invested on day one as well, another advantage which I think is overlooked, is simplicity. I personally hugely value simplicity in my personal finances. It's one decision to get invested, one and done, and fewer decisions to make means fewer opportunities to make mistakes. Option two, so if you're not comfortable investing everything on day one, option two would be to phase in the investment over time. The key here is to have a plan. You've got to have a plan to begin with, whether that's dividing the pot of money that you have up into 12 and investing on the first of each month. You've got to have a plan in advance. Benefits of this approach are not mathematical. As we've covered, markets tend to go up, so you're betting against history and you're betting against probability by following this approach. But I get the emotional dividend that comes from following this approach, particularly if we're talking about life-changing sums of money. By phasing in over time gradually, each tranche of investment takes on less importance. So the chances of seeing a large drawdown in the value of your portfolio are reduced. But I would prefer option one if you can afford to go down that route. You've got to have a plan though if you're phasing in, and a good advisor can help you here and assure accountability. The situation that you don't want to get into, and this is the third option, which I mentioned at the outset, is trying to invest by feel, to buy the dip or to buy when the coast is clear, because the chances, as Megan has said, of nailing the timing on the way in are absolutely negligible. It would be like winning the lottery all over again.
Megan, let's bring you back in. As a chartered
Yeah.
financial planner at Quilter Private Client Advisors, what are the costs in getting into the market? Are there any differences in getting in immediately in one lump sum? Is it better, cheaper, in the longer term to drip feed into the market? Is there a difference between the two?
It's probably as broad as it's long, to be honest with you, Jeremy. From a cost perspective, it depends on what you are investing in. So if you were investing in collective funds, for example, typically you've just got the ongoing charge of that fund. Whereas if you're investing in direct equities, then you might have some transaction costs and some stamp duty to pay in the first instance. So it purely depends on what that underlying investment is. But charges are naturally very important consideration when investing, because depending on what they are, they can slowly erode any growth within the pot. So it's certainly important to sort of research not just the investments but the charges related to them as well.
David, back to you as an investment specialist. Growth versus income. What are your thoughts at the moment?
I think it's important to maximize your investable universe, Jeremy. So what I mean by that is every time that you prioritize a certain investment strategy, you are excluding investment opportunities from your universe. When you're looking at growth or income, I've had some clients over the years who absolutely prioritize investing in companies which pay large dividends. And I get that. But if you were to look at, a dividend strategy over the last 10 years versus global equities has materially underperformed, because a lot of the best performing stocks in the market have been these companies which pay very, very low dividends or no dividends at all. I'm thinking primarily mega cap technology in the States. So I think really, tax notwithstanding, because the client's tax position can have a material impact on whether you try to generate return through income or capital. But tax notwithstanding, I prefer to try and balance the pair, which is probably a really boring investment manager answer for you, but it's the truth. I think you want to maximize your pool of available investment opportunities and not stick too rigidly to one strategy, would be my advice.
Just going off what David's just said, this is why, and the tax implications, this is why getting that structure right at the beginning is so important, because ultimately you could be invested and do really well, have some great growth, but ultimately if you've not tax efficiently structured the money, you could end up paying a huge tax bill which completely eats into that growth. For example, talking about growth via income and dividend paying companies, if a client's got an ISA and a pension where any dividends received are effectively tax free, then David might be looking to put those dividend paying companies in those type of assets rather than the likes of a general investment account, whereby the client would then subsequently pay tax on it. So this is why the structure is so important to then build in the underlying investments.
One final question, David, to you.
Yeah.
As a general rule, what do you do to hedge out to iron out any of the risks? Is it possible in a normal portfolio to do that? We talk a lot about risk. We talk a lot about the risk in entering the market now, possibly. Do you, as an investment manager, structure someone's fund to hedge?
Not only do I think that you can't hedge risk, all of the risks possible, I don't think you should want to. Risk is the price that we pay to generate return. So you have to be accepting of some kind of risk in order to get returns which are over and above inflation. The way that we hedge out risk or try to mitigate volatility within portfolios, probably a better way of putting it, is simple diversification. Not just investing in the stock market for clients who it's not appropriate for, having positions in other assets that historically have gone in a different direction to stocks. The challenge so far this year has been that the obvious port of call for diversification, which is bonds, fixed income, have had an even worse start to the year than equities. They've both gone down. We looked at this a couple of weeks ago. It's the first time since 1990 that you've had two concurrent quarters where global equities and gilts have fallen in tandem. So it's been a pretty rotten start to the year for diversification, but diversification is absolutely not dead. And if you've had positions in commodities or energy stocks, those are what have helped you so far this year. So, in answer to your question, in summary, I don't think you can ever hedge out risk totally. I don't think you should ever want to. By going into cash, you're taking on inflation risk. But when we invest for people, the way that we try to mitigate the worst drawdowns that the stock market occasionally throws up is by investing in other assets within the portfolios. Bonds, property, alternatives, and a little bit of cash as well will help you do that.
Spreading a risk, wise words. Look, we'll have to leave it there, but thank you so much indeed for joining us. It's been an absolute pleasure catching up with you both. That's Megan Rimmer from Quilter Private Client Advisors and investment manager David Henry from Quilter Cheviot. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.